So today we're going to talk about the most talked about UK stock in the last 24 hours, WH Smith, and also a highly requested one in the comment section on yesterday's video. A lot of you guys are asking, can you do a video on WH Smith? So here you go today on WH Smith. Apologies for the late video, by the way. I was trying to get this video up at 5 p.m, but it's just been an absolute crazy day. Went to play paddle earlier, which is fantastic. I don't know if any of you guys have played it, but great game. A little bit of a lazy tennis because you don't have to chase the ball with the walls. And then I had some new patio slabs delivered to the wrong address. I had to phone the delivery driver off, like, no, you need to come back with your big crane and move it to the right driveway. That happened, and then I went to go change a kitchen tap, and then I realised the flexi pipe that I was putting on was broke and there was an O-ring missing. Turned the water on, found out the hard way with water spraying everywhere, and then I had to get the new flexi pipe and put that on. And then we're here making the video on WH Smith. And yeah, what a day. So anyway, rambling on, but busy day. So WH Smith, so significant drop yesterday. That's what everyone is looking at. 42% drop, significant drop there on WH Smith. And not even just like yesterday, the drop. Really, since 2021, the stock's been on a pretty significant downtrend, down 42%, and then boom, we've fallen off a cliff. So from the highs of where the stock was £18 in 2021, now down 62%. If you actually zoom out now, WH Smith is actually lower than where it was in COVID times by 30%. When you think about the fear that was during that time frame and the 30% lower than there, when the world shut down, a retailer, high street retailer, nobody going into your shops, travel agent, travel shop, nobody traveling, and it's 30% lower than there. And if you actually look on the share price, you have to go all the way back to 2013 before you get to where the stock is up. So yeah, like 12 years of share price appreciation lost, which is incredible. Now looking at today, bit of a rally today. Stock is up 11%, and the good thing is that as the day's gone on, the stock has rallied up more and more. So bit of strength there in the stock chart. It did push the stock up to nearly 5% dividend yield. It has just dropped down slightly with the run up today, but yeah, WH Smith pushing up to a 5% dividend yield there. Now looking at WH Smith, I've got to say, I mentioned a few weeks ago I need to have a look into it because I've not looked into WH Smith for a while, and last time I looked into it, the company was actually doing really well. I bought a little bit during the COVID situation, but it bounced up and sold it for like a 20-30% gain, and I've not looked into it since. And I looked into the business last night. I was looking at the company last night, and I was looking at it this morning before the market opened, and I've got to say, I was impressed. Like, this company is in a lot better place than what I remember it being. So the best thing to think about WH Smith is the global travel retailer. So this headline they've gone with in the investor presentation is key. That's what they are, a global travel retailer. A lot of people think of WH Smith as the high street retailer. Not anymore. The high street retail business has been totally sold off. If you go where a WH Smith will be now, you'll probably even see the signs changed. It's a bit weird because you walk past and you look twice. And yeah, they've gone off the high street. They sold the business, and now they have come just the global travel retailer. So why have they done that? So the reason why is because the high streets have been performing poorly, less foot traffic. People just don't seem interested going to WH Smith's when they're out shopping in the city centre. But when you're travelling, train stations, airports, there's so much more foot traffic there at the moment. The travel is just increasing more and more. The thing is, you're limited on choices where you can go. So when you're in town, you've got so many options. When you're in the airport, there's only a couple of places you can go to. And when you're in the airport, you're a little bit more willing to pay that little price. You're a little bit, you know what, I could really do with so-and-so. So you're going to go, I'm going on holiday, I'm going to spend this, I need to get some shampoo, toothpaste. All of these things start happening when you're in the airport compared to when you're in the high street. And the combination of higher foot traffic, that kind of a little bit more open to spending a bit more money, a little bit more pricey, and the limited choices then works very well in WH Smith's favour. So this is why they're now shutting the high street stores, just going to travel, opening up a few places in airports and train stations in the UK, but international. International is what is going to be a big growth driver for them in the next few years. And you can see the success that they've recently had. If you look at the last 6 months, the total travel part of the business went from 670 million up to 712 million. Whereas you look at the high street has been a bit of a a headwind for them for the last few years, or probably more than the last few years, and that went from 256 million down to 239 million. So that's obviously caused you have this great travel business doing really well, but it keep getting knocked down by the declining growth of the high street. So you got the high street declining by 7% a year, but you've got this travel business growing at 6% a year or 8% on a constant currency basis. And you look at the travel part of the profit as well. You got travel trading profit up 12%. You look at the profit margins on the travel, up 40 basis points, which is obviously, very impressive growth from a revenue and a profit point of view. And it's not just in recently. If you zoom out and look at financial year 15 to financial year 24, 12% CAGR. You look at the travel trading profit, 80 million to 189 million, 10% CAGR on the trading profit as well. And as we see the demand for travel increasing more and more, that's only going to benefit someone like a WH Smith's. Global passenger forecast for the growth in the next few years is expected to grow significantly. And you'd expect WH Smith to be, benefit from that, from the travel, the new locations where they expand more and more. And people who like-for-like growth here, you've even got like-for-like revenue growth up 7% at the moment, which is higher than B&M, JD Sports, all them sort of retail stocks in the UK. So the growth here is, significantly strong. And you can see, if you zoom out, the travel revenue, 44% of the business, now up to 76%. And you can see the growth here over the last few years. You look at the high street, it's just been a big headwind, declining more and more. And that's, you got this amazing travel business, and it's been kind of like knocked down every so often by the high street. Now, the big benefit for WH Smith is it's, got rid of it now. So the numbers you're going to see, there's going to be a little bit of a knock in the next 1 or 2 years because, the comps have to come out. But the growth now is obviously going to be so significant. They're not going to have this headwind every time they report that they've got to take out these high street numbers. So you've got a really good travel business, and now it's just a pure travel business play, which is obviously really good. So I was looking at WH Smith and I thought, this is actually a lot better than what I remember it being. Now, obviously, the stock is down. So it sounds very positive, but we have had a bad update from them. So what happened? So there was an RNS posted yesterday, as you can see here. Profit warning, update North America revised guidance. In preparation for the group's end-of-year results, a current financial review has identified an overstatement of around 30 million. So that's your first issue, 30 million. That's a significant amount to get wrong. If it was 2 or 3 million, you might let it go. 30 million is a significant amount to get wrong. Of headline trading profit in North America. This overstatement is largely due to the accelerated recognition of supplier income in the North America division. So this is the tricky thing because you are quite flexible on what you can report the recognition of supplier income. There's quite a big period of time. Now, the problem is that it's quite significant amounts of money, and for it to get pulled up is quite a big, that's not great. And that's why, if you look here, the headline profit for the North America business is going to be 25 million, down from the previous guidance of 55 million. But profit before tax is still 110 million. So there was a bit of a downgrade on the profitability, but obviously, 20-30%, but the stock fell a lot more than that. And the reason why the stock fell a lot more than that is because the market went, oh, fudging the books. Is that's what's been happening? Now, in my opinion, it's just a really bad mismanagement of financials. If it goes down to the CFO, if it goes to someone down at the financial team of the North America business, just maybe accounting something that they shouldn't have been accounting for. Maybe they wanted a little bit stronger numbers and they pulled it forward a little bit, and it's probably a little bit more than what they're supposed to do, and they're hoping that they could cover it up. We'll see. The other thing is, obviously, the other side of it is that, okay, they've covered it up. Has this been going on a lot more? Is there anything else that kind of been covering up? And that's where you get the fear from, and that's why the stock dropped so much. Like I said, for me, I think it's just a general mistake. You could argue the case though, and that's why the stock has dropped so much. There's a bit more going on here than that. But for me, it's an accounting error. Now, the other thing is that when I look at the business, when you look at who's in charge of this, so WH Smith as well have recently got a new CFO. A new CFO came in December the 1st, 2024. So for me, obviously, you wouldn't be a point there where you're trying to fiddle the numbers like that. You're probably there trying to make sure you're doing a bang-up job. But being a new CFO, have you got grips of it? Do you know what's going on inside the business? And the fact is, it's a new CFO into the business makes me think, okay, come into the business, bit of mismanagement coming on. And also, when I look at the new CFO, I think he also made a bad decision where we saw Funky Pigeon sold off by WH Smith to Card Factory. Now, as a Card Factory shareholder, I own shares in Card Factory. I actually was quite welcoming. I was like, yeah, this is a great deal. 24 million, like they paid like 4 times EBITDA for it. I was like, yeah, that's a great deal. But looking at WH Smith's point of view, I'd be looking at the CFO going, hold on, you sold off a part of our business for way too cheap, and now we're getting told that we've got an accounting error. It's not looking good for the CFO, and that's probably what I would expect into the next few days now, is I would expect WH Smith to come out and say, like, unfortunately the CFO's gone, can't be making mistakes like that. I think you might be a few people in that North America business. I think a few heads are going to roll from that point of view, and that's what I'd expect to happen from a pretty basic mistake that you should be making, and I think that's where we're at. I'd also like to see WH Smith with some commitment from the management team here to also buy a few shares in the dip. I think also if they have the ability to do a share buyback, that would be something as well that I would expect from the management team in the next few days. So that is where we're at with WH Smiths. Now, when it comes to a point of view of like, is it an interesting buy? I was looking, and what I was having a big think about and what made me nervous is the balance sheet. Like, the balance sheet is a bit of a mess. Like, you look here, 493 million on debt. It's about a third of the market cap. Debt to equity is about 129%. They are 39 million on cash at the moment, so it's not amazing. It's not amazing balance sheet. And historically, if this was a better balance sheet, I'd be like completely all over it. So I was having to think about this stock until I had to think about it last night, and then this morning I got up quite early and I was looking at the numbers, running numbers, thinking how to think about it. I'm thinking, okay, the balance sheet's not great. There is the issue with accounts, but I don't think it'll end up being something in a problem in the longer term. Is it a buy? And I thought about the financials, and I thought, you know what, these financials are actually better than B&M, a Card Factory, JD Sports. The profit's growing at good rates, revenue's growing at good rates, like-for-like's growing at good rates. And I looked and I ran the numbers, and I don't know if it's going to be on here, but if they did get to an 84p EPS when they do start recovering after all these charges, you're around about 7 times earnings, which 7 times earnings isn't too bad. We've seen B&M at those levels, Card Factory at those levels. Granted, with those companies, you don't have this accounting issue going on, which I think for a few people would be enough to go, I'm not buying that because of that issue. I don't blame you. But with this company as well, you are getting a company that's financially doing a lot better. And you can also see that from a point of view where you look at WH Smith's, and previously WH Smith's was like a 10 times earnings business. Nobody wanted to own it because it was referred to as a dying kind of high street brand. But this travel business, we can see here, it's got great success. And the market, since it started doing its travel business, really since 2015, you can see here as they improved, the market went, wow, there's something here with this business. And the market put it from a 10 times earnings to 11 times earnings, 14 times earnings, 15 times earnings, 17 times earnings, 21 times earnings, 21 times earnings in 2019, and then you know what happened next. And then previously, before that, after that, it's been about a 24 times earnings business. So for it to fall down to 7 times earnings, if they do get to the EPS that they're expected to do this year, which obviously they're not going to do, but in the likes of 2026 and the likes of what they did in 2023, obviously they did even higher in 2024. They did 97p. So I looked at that, and I was sat last night and this morning. I was sat there thinking, I really like this. I like the business. Great business. No arguments about it. It's probably an even better business at the moment than Card Factory and B&M. I'm okay with not okay with the accounting issue, but there's a lot of that priced in at the moment, and I think it is a genuine, like, just basic mistake, and it shouldn't have been there. Nothing more than that. I don't think anyone's cooking the books or anything like that. But you never know, but that's my opinion. I looked at the balance sheet and I thought, oh, when I'm in these situations, I like to have a strong balance sheet. So if it takes a year or two to get out from this situation, they can deploy a couple of share buybacks, dividends, okay. I like to have a strong balance sheet. And the only thing that really was holding me back was the balance sheet. And then eventually I thought, you know what, I'm going to run the numbers here. Is there upside? Can I buy? And yes, I did. So this morning, you can see on the Patreon 9 hours ago. So, obviously this is why sometimes it pays to be on the Patreon. I did post before the market opened that I have decided to buy WH Smiths. I also bought another new stock as well, by the way, which I'll talk about next week. I'll have to cover that one out. But yeah, I did decide I'm going to go into WH Smiths. Now, obviously, so far, looking pretty good. We're up a good, something like 10% at the moment, which is absolutely great. And yeah, these issues with the accounts, but I don't think it'll be anything major. I think we'll just see, a couple of heads rolling because of it. The balance sheet isn't great, but that travel business is actually really good. So I thought, I'm going to buy it here. And I was looking at the numbers here on WH Space, and I put 3-5-7% growth in. Profit margins of 4-5-6%, 12 times earnings, so that's obviously a lot lower than where the market's been putting in recently. And there's 13% upside, 52% upside, and 67% on the high side. Now, obviously, this is before the stock opened up this morning, so obviously it might have changed slightly. But I said to myself, okay, I put it at 12 times earnings. Like, I don't even think it's going to be 12 times earnings, but I'll go 12 times earnings. And, I was seeing a good 50% on the high side and 97% on the mid side and 97% on the high side. I was like, okay, that's good upside. And obviously there's a dividend yield of 5%. So 25% on top, you're up to 75 and 125. That's great. And let's say the market all of a sudden goes, oh, you know what? We get rid of the CFO, make some change to the management team, they get the trust back with the market, and the market goes, maybe not 24 times earnings, maybe not even 21 times earnings. Let's say like 15, 17 times earnings. Let's say the market does start going, okay, we'll give you a little bit more trust. And the market pushes it back up to a 17 times earnings. Well, if you put it back up to like a 17 times earnings, there's over 100% on the upside, and then even up to 179% on the upside. You have dividend on top, you're up to 200% upside. So for me, when I'm seeing those numbers there, I'm like, you know what, this is worth probably the risk to reward for me going in here. So with the numbers, the travel business being good, I did buy. And I'm currently owning a bit of WH Smiths. I'm up 10%, and that's where I'm at. The longer term game plan is that I only bought about a third of a position in case we do see a bit of volatility, the stock does drop lower, there's an update that the market doesn't like. So I haven't really got like a big position, especially obviously as well considering that there's the issue with the accounts going on. So my thoughts are at the moment that I'm going to buy and hold these shares, and if the market gives me, I don't know, it depends what happens next on the stock price. If we see a slow, nice tick up, I might hold it a little bit longer. But if we have a quick rise back up to where we were at before the whole account situation, I might lock in my profit and see there. So I'm not really decided where the long-term game plan is yet with WH Smith. If it does come into a longer-term hold, or if it does have a quick bounce, if I do release the money in and then move on from there. But the big decision I had to make this morning is, do I buy? And the answer to that is, yeah, I did buy. There's the account issue that we mentioned, and also the balance sheet. But overall, I think when we look at the travel business, it's look at that. 12% CAGR on revenue, 10% CAGR on profitability. These are great numbers, really, really good numbers. I thought, I'm going to have to buy it 7 times earnings and a nice 5% dividend to keep me warm. So, yeah, I did buy, currently owning WH Smiths, and we'll see where we end up in the longer term. And we'll see over the next couple of few days where where we get probably a bit more information about what's gone on with the account issue, and then obviously how the stock market responds. We saw a few buyers buy up the dip today. And we'll see what happens in the next couple of days as well. So I hope you enjoyed it. Have a great weekend. I'll probably see you on Sunday. I'm going to talk about a new stock I'm buying, which was supposed to be today until this WH Smith crash happened. But yeah, hope you enjoyed it. See you in a bit.